Hi there, it's Richard here from the Private Client Legal team. And I'm going to speak to you very briefly about trustees' powers of investment. So this, by way of reminder, is where trustees are holding assets on behalf of beneficiaries, and they are under an obligation to manage those assets in the best way they can. So, as I was saying in the first point in this slide, there is an active duty for the trustees to be quite hands-on and to consider how best to use the assets that are under their disposal, because remember, they are the legal owners of the assets and they are under an obligation to make sure that the beneficiaries get as much out of the trust as is reasonable, really. And in order to allow trustees to do this, the law gives them an awful lot of power. Section 3 of the Trustee Act 2000 says effectively that you trustees can treat these assets as you want, as if you were the beneficial owner of them. So treat the beneficiaries as you would want to be treated yourself, basically. And that is subject to, unsurprisingly, the trust deed itself. If there is something in the trust deed that says, actually, we want to rein in the scope of those powers of investment, and we want you to only invest in these assets or these classes of assets, then that takes priority over the statute. But as a default position, trustees effectively can treat the assets as if they would treat themselves. So a lot of power there. What's the flip side? The flip side is, of course, that means there's personal responsibility on the trustee to make sure that these assets are invested properly. So it might be the trustee might consider that the assets that they are in control of are so significant and the burden of personal responsibility is so onerous they might consider delegating some of the functions to others. So what guidance is there for trustees and how they should invest? Now, there is something called the standard investment criteria, and that is quite a fairly straightforward, actually, in theory, two-stage process, saying to the trustees that when you're looking to invest the assets, you have to think of, firstly, is this the kind of asset that I should be investing in on behalf of the beneficiaries? And what that means really is that who are the beneficiaries? When are the beneficiaries likely to need funds? And how much are the beneficiaries really expecting? So you can think, well, if the beneficiaries, for example, are likely to need funds on a short-term basis, as and when, then the type of investment might have to be easy access short-term investments. If, on the other hand, the trust is likely to hold assets in the trust for a long time, the trustees might consider that a long-term investment might be better off because the payoffs could be more significant. So the first stage is the type, the kind of investment you're making, short-term, long-term, even if the trustees have certain beliefs, such as they should only be environmentally friendly investments. These are the kind of investments they should be thinking of. The second part of that is, having considered the kind of investment, is the particular investment that the trustees are looking to invest in, is that suitable for this trust and for these beneficiaries? So it's a hands-on, active approach to investment management, but they should always have regard to the standard investment criteria. If, as I suspect a lot of trustees of high-value trusts are likely to do, they've delegated those powers to somebody else, there's again the obligation to check in with those delegated functionaries to make sure that what's going on is in the best interest of the trust. There is also an obligation on the trustees to take advice prior to taking any investment advice. So it's all very hands-on, it's all very active, not to be taken lightly, certainly, but they should always take advice and keep the standard investment criteria in mind. Okay, that's my brief presentation on trustees and investing.
Hello, my name is Guy Sterling, and I will be talking today about investment policy statements for trusts and their tax implications. I will start with an overview of the statements themselves, then move on to the different entitlements a beneficiary can have, and finish up with looking at the tax efficiencies and anomalies. So what is an investment policy statement? Well, this is generally a document between the trustees who are responsible for running the trust and the investment manager, covering how the funds under investment are going to be managed. The purpose, well, it enables the trustees to formalize the policies relating to the trust so that they can demonstrate that they are performing their duties correctly and also giving future trustees a summary to guide them. It gives clarity to the investment manager on the types of investment that should be within the portfolio. So what sort of things would we include within the statement? Well, first of all, it would be the history of the trust, why it was set up, and who the intended beneficiaries are. It would look at the income and capital requirements of the trust and what are the growth needs of the trust. It would identify the level of risk that will apply to investments and whether the mandate to the investment manager is on an advisory or discretionary basis. It would cover the quality of the investments that are going to be held, for example, investment grade of bonds and acceptable stock exchanges that stocks and shares can be chosen from. It would also include the ethical preferences of the trustees. It would benchmark to an appropriate index so performance can be measured on a regular basis. And finally, it would include the investment fees covering the transaction costs and annual management charge. So what are the benefits of having the investment policy statement? Well, this will assist with ensuring there's consistency between current and future trust investments. It gives a framework to the investment manager on how to operate the investments, and it demonstrates openness between the trustees and the investment managers. And finally, it provides for review of investment transactions to be measured on a subjective basis against the trust requirements. So we now move on to talk about beneficiaries' entitlements. Trusts can have multiple classes of beneficiaries, and commonly these are split between different generations, with the first generation having a right to income and the second generation having a right to capital. The trustees are required to be mindful of all beneficiaries and not to prioritize one class over another. So how does this impact on tax? Well, we first of all look at tax efficiencies. The investment managers need to be aware of the tax consequences that will affect their investment decisions. First of all, the trust will have an annual exemption from capital gains tax, and if this is not used in a tax year, it will be wasted. Secondly, they need to be mindful of the different tax rates on dividend and interest come, so there can be a conflict between good investments and the tax implications. Finally, we turn to tax anomalies. There are some investments that can cause conflicts between different classes of beneficiaries. Firstly, there are assets which, when sold, are taxed as income rather than as a capital gain. The gain is therefore at risk of being for the benefit of the capital entitled beneficiaries, but the tax is suffered by the income entitled beneficiaries. Types of investment include offshore funds that do not have reporting status and life insurance investment bonds. A different issue arises on accumulation shares, where income is reinvested in the asset rather than being paid out. So again, the income entitled beneficiaries suffer the tax, while the capital entitled beneficiaries have enhanced capital in the trust. I hope that this has helped your understanding of investment policy statements and potential tax issues. But if you would like more information, please do get in touch.
Hello, my name is David Mitchell and I'm a Chartered Financial Planner at Kingston Financial Advisors. Today, I'll be talking about ESG investments, what they are, why they're increasingly important, how they have fared recently, and how to approach ESG investing. So ESG stands for environmental, societal, and governance, the three central factors in measuring the sustainability and societal impact of an investment in a company or a business. ESG is broadly aligned with, but not identical to, ethical and environmental investment strategies. The infographic on this slide sets out some of the key areas where a company will be assessed for its ESG rating. For example, heavy polluters and companies with autocratic and exploitative management will score poorly, while companies with a low carbon footprint, diverse and fairly remunerated management team who take great care of their staff will score highly. Recognising the importance of ESG issues goes all the way back to Cadbury's, who founded Bourneville as a model village to cater for their workers' well-being. Nowadays, asset managers and other financial institutions increasingly rely on ESG ratings agencies to assess, measure and compare a company's ESG performance. ESG is becoming more important because people care about what happens to their money. People are also very concerned about the issues addressed by ESG. Excuse me. The expansion of the world economy has led to an increase in global temperatures. Sea levels have risen, the oceans are becoming more acidic, and there's been a greater frequency of extreme weather events globally. At the same time, human rights, equality, diversity, and the fair treatment of workers are rightly coming under more scrutiny. ESG considerations have started to push money towards investments that can help solve major problems. According to a report by Credit Suisse, net inflows into ESG funds rose from 18.1 billion in 2017 to 73.2 billion in 2019. That's million US dollars. Investors in Europe accounted for 55.9 billion of these inflows. The graphs on this slide show the performance of 5 of our preferred investment partners' balanced ESG portfolio against the average for all funds in this sector. The balanced sector is roughly 60 to 70% in equity. Companies with high ESG scores have performed well in recent times, and there's some obvious reasons why this may be the case. For example, many technology companies will have a high ESG rating, and ESG portfolios will have limited exposure to oil companies and airlines. However, there are also reasons to believe that companies with a diverse representative board, good employee relations, and which meet or exceed sustainability targets will continue to do better than equivalent companies in which these issues remain unaddressed. So the data suggests that recent times managers following ESG sustainability mandates have performed at least as well as the mainstream of the sector average. However, as always, past performance is not a reliable indicator of future returns, and investments can fall as well as rise. So when looking at an investor's approach to ESG issues, there have always been plenty of non-financial criteria for deciding where to place money. And there's a trade-off between what may be termed investing with a clean conscience and investing to change the world. On the one hand, screening out companies involved in certain industries such as the arms industry or alcohol, tobacco, or based on other specific criteria. And on the other, engaging with companies and countries to influence to do more. It's important for you as an investor to establish your priorities. We use a very simple questionnaire to help identify the key themes, and my colleagues and I can help you to find the right investments to meet your preferences. And we'd be delighted to discuss how you can incorporate ESG principles into your financial planning. Thank you very much for joining us, and do please feel very welcome to get in touch on this or on any other planning issues. Thank you very much.